In the last video, we introduced the idea of financial intermediation. If you need a refresher, you can click the link up here. In that video, we described how a financial intermediary helps to match those who have extra capital and those who need it in a way that improves the lives of both parties. We talked just a little bit about stock markets and market makers that help to keep the markets functioning. In this video, I want to talk about the two different types of equity transactions that investors and companies can make. If you want to learn more about primary and secondary markets, stick around. When a company first issues stock, it's said to go public. When that happens, they call it an IPO, or initial public offering. During the IPO, the company sells shares to the investing community in exchange for cash. Normally, an investment bank brings these shares to market and helps to sell the shares to their best customers who are looking for good investments. These transactions are said to be primary in nature. A primary transaction is when the company sells a security to the investor directly. This can be contrasted with a secondary market transaction in which some other investor buys the shares from the initial investor, allowing the initial investor to cash out of their position. But when that happens, does the company get any more money? No. That secondary transaction is simply between two different investors, and the company doesn't really have much to do with it at all, except to record the transaction once it clears. The vast majority of stock sales are secondary transactions. In fact, the company only gets money on the day that they do their IPO. Note, it's a little bit overly simplified because the company can still take part in the secondary market and buy and sell their own shares, but most companies do not actively trade their own stocks because they're too busy running the business. The presence of a robust secondary market makes it easier for investors to get out of an investment when they no longer want to hold it. We say that investments that are easier to get out of or convert to cash are more liquid. Investors demand a premium for making illiquid investments. As such, an active and efficient secondary market means the value of the primary transactions are likely to happen at higher values because the investors will not discount the transactions for being illiquid. Most primary and secondary transactions happen in the same market. The only difference is who's selling the security and who gets to keep the proceeds of the sale.